Alright, so welcome back to our discussion on Chapter 10 and our introduction to liabilities. So where we left off, we were figuring out how much to accrue for this note, and I was looking at the problem, and the number is kind of weird if you use September as the signing date. So I'm just going to switch it to October 31st. So just keep that in mind. And doesn't it change our issuance transaction at all? So, because issuance only takes the face value. So let's go back to the problem now. So the 100,000 face value, we're gonna multiply that by the 8%, which is over here on the right, and then we're gonna multiply it by how much the period of time it was outstanding during the year. So like divided by 12, and so it's October, November, December is 3 months because we signed at the beginning of October and then it lasted through the end of December, so it's all 3 months. So this is going to be 3 divided by 12. It's very difficult to write with my finger on here. Alright, so doing this now, you should get a clean number actually. Yep, so we get 2,000 now. So this 2,000, it's going to be an increase to a liability because this is interest that we're going to have to pay in addition to the initial like face value of the note. We're going to have to pay an additional amount because if we didn't like include interest, why would the other company allow us to just have $100,000 and then just give it back to them later? You know what I mean? Like they're gonna want something else in addition to this. It's kind of like the time value of money. All right, so it's gonna be interest payable, and that's gonna be a liability, and then we're gonna decrease our retained earnings with a decrease to or an increase to interest expense. But it's going to decrease shareholders' equity because it is an expense. So, and that is going to be interest expense. So what we've done so far is we've recorded the face value of the note right here. So we got $100,000 cash, and then we recognize that we have to pay $100,000 as a payable. And then on December 31st, we're saying that we're recognizing that we've already accrued $2,000 interest as a result of holding the note for 3 months. So now finally, to wrap this part of the problem up, we have to record the maturity, what's going to happen on the maturity date. And there's actually two different ways to do this, and I'll just go through both of them. Whatever way makes more sense to you, go for it. All right. So on the maturity date. So on the maturity date, we have to recognize the fact that first off, we're paying off the note and the interest. So we have to recognize, us paying all that off. We also have to recognize that after the initial 3 months, we held the note for another 6 months. So we have to include that interest in here somehow. And one of the ways you can do that is you can create another payable before you record the whole cash thing, or you could record it as just one transaction. I'll show you how to do both. So let's start when we start off by just creating another payable. So like I said before, it was a 9-month note, and we already recorded having it for 3 months. So now we have to record it an expense for holding it for the other 6 months. So this is just going to be this 6 divided by 12. So let's do that quickly. Actually, this should be 4,000. Yeah. All right. So it's going to be 4,000. So we're just creating a 4,000 here. So then again, this is just going to be interest payable and interest expense. And keep in mind too, as we're doing these, that you're also going to have to know how this affects ratios and financial statements. I mean, if you get really stuck on the financial ratio part, just do this and then see how it's affecting all the pieces of the accounting equation. And it should make it quite a bit easier. And if it still doesn't make sense, you can also put in fake numbers, and it'll make more sense too. So our liabilities are increasing again, and we're decreasing shareholders' equity because our expenses are going up. So that's how we create the the payable for the second part, or for holding the note for the other 6 months. So now what we have to do is we have to show what happens when we actually pay the note and the interest. So obviously we're losing cash, so it's going to be 100,000, and it's actually going to be another 6,000, because if you remember, we had 2,000 from the previous point when we accrued interest, from the December 31st transaction. We had 2,000, and now we have this 4,000. So 2,000 plus 4,000 is 6,000. So both of these are cash. I just separated them to make it maybe a little bit more easier to see. So now we have to clear that 6,000. So this is going to be interest payable, and then we're going to clear the principal, and that's going to be a note payable. So this is how you do it if you want to just create another liability and then just like clear it. So these are both cash. So it's going to be a debit of 100. No, it's a credit of 106,000 cash, and then a debit of interest payable of 6,000, and then 100,000 of note payable, the face value. All right. So now let's talk about the other way, where you can just combine it into one transaction. So no matter how you do it, you're going to pay the same amount of cash. So I'm just going to combine it into one this time, because you know where both sources of cash are coming from. So this is going to be 106,000 cash, and we're losing it, so assets are going down. Now again, the 4,000 is going to be from the other. Actually, no, we're just going to expense that. So we're going to pay the 2,000 from the holding it from December 31st. So this is going to be the interest payable. And then we have to clear the face value of the note again. So it's just going to be 100,000 note payable. And these are liabilities decreasing because we don't owe them anymore, or we're like meeting the obligation to pay them. And then we just expense the shareholders' equity over here. Oh, actually, this is going to be decreasing. So again, we're expensing it, so shareholders' equity is going down. And this is just going to be for the last couple months of holding notes. So this is going to be interest expense. So both ways work. Whatever feels more comfortable to you. As you can see, like, both keep the accounting equation in balance. So again, whatever makes more sense to you, go for it. All right. So now some other things that I would look over. I would look over like the definition of a liability. So a liability, of course, is an obligation of a company to disperse assets or provide services in the future. And liabilities can be current or long-term. So a current liability, remember the definition of an operating cycle. So like whatever is longer between a year or the time that it takes you to like sell an asset. So if you can resolve a liability within that time frame, it's a current liability. And then if you can, it's a long-term liability. And liabilities can have a long-term and a short-term component. And then you can also not even know like the amount of a liability sometimes. And those are called contingent liabilities. You wouldn't actually record those like on the financial statements, but if you don't know the amount, you would record it in the footnote. So like if you're getting sued because your company dumped chemicals into like a water source or something, and you're pretty sure you're going to lose the case, you're going to owe money, but you're not sure how much, you wouldn't put that as a liability, but you would disclose it in the footnote saying, hey, we're going to probably lose this case, or we're going to owe some people some money. So that's called a contingent liability, where you don't know like if you're going to incur the liability first of all, and you're not sure about the amount. Now this also only happens if the event is like if it's probable that's going to happen. So if like a meteor came, like if there was like a very slight possibility of a meteor coming and striking your facility or something, you wouldn't record that as a contingent liability. Well, I guess you wouldn't owe the meteor or something, but you know what I mean. It has to be likely that it's going to happen, and you also have to know how much it's going to be for. If you have those two things, then you would just put that contingent liability on the balance sheet. So review those things and you should